My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to save you some money. My job, not just to entertain, but to educate. Put this one in perspective. So call me at 1-800-743-CNBC or tweet me at Jim Cramer on another ugly day on Wall Street where the Dow shed 413 points. Sell. S&P lost 1.69%, and the NASDAQ tumbled 2.18%. Let's get one thing straight. I hate the big pivot. I despise that the large cap tech behemoths have gone out of style, along with their small mid-cap enablers. But ever since November, when the Fed decided to crack down on inflation, these stocks have been dumped into the meat grinder. Now, I don't really want to pick on FANG, but it's time to retire this once great acronym that I created many years ago, if only because 3 out of 5 changed their names. These stocks, Facebook, now Meta platforms, Amazon, Apple, Netflix, and Alphabet, along with Microsoft, the semiconductor stocks, and the cloud-based software plays, simply don't thrive in an environment with high inflation and rising interest rates. It's not their fault. Digitization takes a backseat to interest rates now that they keep going up. Doesn't mean they're finished. They all have fantastic growth stories. They can pivot too. But this is a market that covets value stocks. And all of these FANG names, the only ones that are really cheap relative to growth rate are Alphabet when you back out the cash and Facebook, one of which we bought today and the other I want to buy more of if it comes down. Investing Club members, of course, get that call. My Charitable Trust finished last year with a lot of tech because we thought the pain would be contained to the highest multiple growth stocks with no earnings. That's how things played out during the 2015 inflation scare. Seemed like a decent blueprint. At the same time, there were so many junk companies that came public via IPOs and SPAC deals that I thought we had a real opportunity to clean out the dross and focus on solid growth. We were done with the flying cars, the electric vehicle battery parts, multiple grills, even as I kind of like those stocks. These offerings had sucked up so much capital that they made it difficult to keep more mature growth stocks going. I'm thrilled that we were able to get so many people out of these formerly high-flying price-to-sales names. Saw a bunch of people this weekend who said, hey, thank you. But what surprised me is that inflation has even gotten hotter. The market didn't turn on all things growth, not just the ones with no earnings, including the ones that trade on earnings and not just sales. Now, most of these are plays on cell phones or high-performance computing or digitization of the plumbing behind the internet, 5G. I also misjudged how much money went into crypto that I thought was ready to go back into common stocks. Can we just admit it? Crypto trades with the NASDAQ at a time when you don't want to be trading with the NASDAQ. Now, I am loath to sell all of these tech growth names. That would be a mistake. I'm confident if we could just get a couple of interest rate days to stabilize, it would allow the best of the growth names to make a comeback, and we have plenty of room to buy our old favorites. But I don't see that happening, let's just say, in the near term. We're about to go into a series of terrifying inflation numbers. It's entirely possible that these numbers, consumer price index, producer price index, will be better than feared since everybody fears them. But even if they're peaking, we still have a problem with food and oil inflation, courtesy of the Russian invasion of Ukraine. Plus, there's a gigantic COVID outbreak in China, with the government imposing a severe lockdown on the parts of the country that are most essential to the global economy. The good news is the freight rates all across the country and even the world are coming down. That could put a lid on some inflation, but not enough to save these big tech stocks, even as they aren't in trouble over supply chain or labor or even freight, unless they have semiconductors they're trying to get out of China. And very few have that, by the way. Most of them are locked up in Taiwan. Now, it's difficult to talk about the Russian invasion of Ukraine in anything but humanitarian terms. The refugees, the death tolls, the pictures. Oh, my God, the Times, what pictures. It's all horrific. But there's also an economic cost. Ukraine represents 13% of all the world's calories, and Russia is the most important energy exporter to Europe. If you cut off Russia's oil and gas production, that's enough for energy prices to stay elevated for a long time to come. In fact, I thought today's decline, part of it's because of the opening of the Strategic Petroleum Reserve, but part of it is just because maybe people aren't as frightened, which is wrong. Oil has given you a good chance to start doing some buying of the quality oil companies. But I want to get back to the rest of the market. I think we're still in the midst of this great reset. We have a pivot out of super growth companies, especially the biggest growth stocks, represented as much as 50% of the gains from the 2017 low. So narrow. And into a market that looks surprisingly like the old days, broad, when we're led by a balanced group of sectors. At various times, healthcare or the financials would be the largest areas of investment, with tech hanging in there, but not nearly as important as it's become. And that's good. Now, I don't think this will be as bad as the tsunami of pain that blanketed all tech from 2000 to 2004. You know what it's more like? Oh, boy, graybeard. It's what happened in 1984, when tech had a couple years run and it collapsed, and it passed the torch to more traditional areas. Or how about this one for more recent? 1991, when the Fed decided to raise interest rates, short-term rates, so that the banks could make fortunes off of their deposits. That's happening again. So let me tell you what I did today for the Investing Club. We cut our exposure some more, after just brutal, endless exposure to tech. And a lot of them we got froze. We told people to sell them last week, but we couldn't because you know the rules. If we talk about it, we have to wait, but you can do it. We raised a lot of cash so we can profit from the pivot, as we expect financials, healthcare, industrials, oils, companies that benefit from consumer spending or an increase in the price of oil, meaning not just the actual oil companies, but the service companies, too. We think they're the new winners. I don't like having to do this. It involves trimming some of my absolute favorite stocks, also taking huge capital gains that have to get sent out to charity because of the nature of the trust. Like last year, we had to send out $570,000, took these big gains. Don't get me wrong, I'm thrilled to have such big gains because it means I can help those who are struggling, including refugees escaping the brutality of the Russian invasion. I just fear that the heyday of the tech giants is over, at least until the 20-year Treasury calms down, inflation peaks, and then maybe we can pick among the techs that still work. For the moment, I do think we have to forget most of FANG, focus on the money centers, the oils, retailers with tremendous scale, health insurers, big pharma. And when I say big pharma, I mean only big pharma, absolutely not biotech, because they're the losers in the high inflation environment. And you know I like oil so much. We'll also have some scattered tech winners, the ones that get private equity bids, like a SailPoint or Proofpoint today, hard to predict. We'll get excited by Elon Musk ultimately attempting to join the board of Twitter and then trying to take it over or sell it. Who the heck knows? We'll be buoyed by fintech from time to time. We'll like the travel stocks on days that oil goes down and hate them on days that it goes up. And we'll get moments where everything works, but you'll still need to stay diversified. And that's the real key. Those with too much tech need a bounce to reposition. I think you're going to get that. I really do. We've been saying that for the Charitable Trust. We had to do some sell. You can follow it by joining the CNBC Investing Club. We'll be doing some more. You need to be positioned with no overweighting to anything except maybe oil, because the industry's newfound discipline on drilling. Oil used to have twice the weighting it has now on the S&P 500. I think it goes back to where it was, if not higher, and you should be buying. Here's the bottom line. Because there's no new money coming in to speak of, and because you're not able to get an actual inflation-adjusted return on treasuries, but you might soon, the great pivot won't be funded by money over the transom. It will be financed by money managers selling expensive big tech stocks until, alas, tech becomes cheap relative to the S&P. Then and only then will we be safe running and gunning those stocks once more. George in Michigan. George.
Hi, Jim. It's great to talk to you.
Thank you, George. What's up?
Jim, a couple of months back, you were real enthusiastic about L3 Harris.
Mm-hmm.
And you got me interested, too, and I've been watching it for quite some time, building position in it. Now, with Ukraine being invaded, it would seem like it would be even more of a highlight for you. But I haven't heard you mention it, and what's your opinion of it now?
You know what, George? You know why you haven't heard me mention it? I keep waiting for a price break. I keep thinking it'll come down, and I'll be able to talk about it because you know how much I liked it. It doesn't come in. Maybe that's a sign of a really great stock. It just doesn't come in, and that is a really great stock. Let's go to Wynneth in New York. Wynneth.
Hey, Jim, this is Wynneth's father. I have Wynneth next to me. She's 16, actually 16 today.
Here we go.
She's going to ask you a question.
Hi, Mr. Cramer. My name is Wynneth. I'm a sophomore at Blindbrook High School in Westchester. My question is on Ulta Beauty. The ticker is ULTA. I bought a little bit about a month ago in the 350s with the intention of adding more lower. I've been surprised that the stock's gone straight up since. What are your thoughts on the stock from here?
Well, this kid's got horse sense because, again, just like the LHX, just like L3 Harris, Ulta's not come in. And yet I think Ulta's terrific. I just went into a new Ulta the other day. I could not believe how gorgeous the merchandise is, how well it's displayed. Ulta's a winner, just like... Oh, and of course, happy birthday, Gwyneth. That goes without saying. I think you get, no, it's the other guy at Sephora, you get the stuff for your birthday. Anyway, look, I hate the pivot, but it is a reminder that we got to stay diversified. This great pivot will be funded by money managers selling expensive tech stocks until they drive tech down to where it's cheap relative to the S&P. Only then will we be able to safely run and gun those stocks. All Mad Money tonight. Growth at a reasonable price. That's what we're talking about. That's the new game in town. And I'm reviewing some travel and restaurant names to fit the thesis. And could Hershey be in a sweet spot in this market amid the run of the packaged food stocks that keeps going on? I'm going to give you my take. And retail's in it, right? Everybody's negative. I'm turning to one of the best analysts in the street. Get his take on the sector, and you better believe it's not negative. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com. Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.